Hey everyone, welcome back to the channel. Today we're diving into the world of dividend-paying stocks, one of the most reliable ways to build long-term wealth through investing. But here's the twist. We're focusing on dividend-paying stocks while steering clear of companies that are heavily involved in receiving or paying interest, like banks or companies with high debt loads. I know this might sound complex, but stick with me because I'll break it down into clear steps and show you how to spot these dividend gems. First things first, why are dividend-paying stocks so attractive? Well, dividends are essentially a share of the profits that companies pay back to their shareholders. For us, that means a steady cash flow and a way to see a return on our investments, even if the stock price isn't skyrocketing. Dividends also let us reinvest those payments to generate compounding returns, amplifying our wealth over time. For example, let's say you invest in a stock with a 4% dividend yield. With consistent reinvestment, that dividend yield could turn into significant gains over time, without relying on stock price appreciation alone. But here's the challenge. Many dividend-paying companies, especially banks and other financial institutions, rely heavily on earning interest as a core part of their business. For some investors, though, earning money this way doesn't align with their values. Some people may also want to avoid companies burdened by debt, which can be risky and reduce dividend sustainability. So how do we find solid dividend-paying companies that aren't dependent on interest income? One of the best ways to filter companies is by looking at their debt levels. A company with minimal debt isn't paying a ton of interest and is less likely to need loans to operate. A great metric here is the debt-to-equity ratio. A lower ratio suggests the company isn't highly leveraged, meaning less dependency on debt and fewer interest payments. You can find this information on most financial platforms. Look for companies with a debt-to-equity ratio below 1.0, or even 0.5 if you want to be conservative. Next, let's look at a company's dividend history. Companies with a track record of consistently paying and even increasing their dividends tend to be financially healthier and more committed to sharing profits with investors. Look for what's called a dividend aristocrat. Companies that have increased their dividends every year for at least 25 years. These companies often have strong, predictable cash flows, making them less likely to rely on interest-heavy income streams. Think of brands like Coca-Cola or Procter & Gamble. Certain sectors are just naturally less inclined to deal with interest income. Consumer staples, utilities, and technology companies that focus on products or services, rather than financing, are great examples. Utilities are especially known for stable cash flows and consistent dividends, making them less likely to need large amounts of debt. Just make sure to research each company individually. Even within these sectors, debt levels can vary. Finally, the business model matters a lot. Companies with a simple, stable business model, like food producers or household goods companies, have more predictable earnings. They aren't as vulnerable to economic downturns, meaning they can continue paying dividends even in tough times. This stability can be really valuable for dividend investors looking to minimize risk. Now, you might be wondering, how do I screen for these types of stocks? Fortunately, many financial platforms have screeners where you can filter by low debt levels, dividend yield, and sector. Look for companies with dividend yields between 2 and 6%. That's often a sweet spot that combines both growth and stability. After applying these filters, take a closer look at the companies that come up. Dig into their business models and financial statements to confirm they align with your goals. Alright, so to sum it up, here's how you can approach dividend investing without relying on interest-heavy companies. Look for low debt, a solid dividend history, stable business models, and focus on sectors less tied to interest income. Dividend investing doesn't have to be complicated, and with these strategies, you can build a portfolio that aligns with both your values and your financial goals. As always, do your own research and make sure each stock fits with your overall investment strategy. Dividend investing is a long game, so patience and consistency are key. If you enjoyed today's video, give it a thumbs up and don't forget to subscribe for more investing tips. Until next time, happy investing!